Well, hello, everyone. Thank you for joining us today for another episode of Two Economists and a Lender, where we take a deep dive into the most important economic issues facing agriculture. I'm your host, Carly Jacobson, and I'm back with David Widmar and Brent Gloy from Agricultural Economic Insights, along with our own Chad Jacobs, a financial services officer serving the Southwest Iowa region. So, depending on who you talk to and how you like to think about equity in your operation, this topic can be a bit controversial. One of the things I appreciate, though, about today's conversation is that you won't feel like you have to pick a favorite. And because, spoiler alert, they are both great ways of looking at equity. Digging into the differences between earned equity and unearned equity can be really powerful. Brent, I love this topic, and I know it was your topic idea. So, really glad to have you kick us off.
Thanks, Carly. This is one of the topics that I wanted to talk about in this series, and in part because I think it's just it's so important and it's so useful as a gauge and kind of the long run of how your business is performing. And it really kind of helps us disentangle two things, and it's pretty easy to do. So it has all of the metrics that I like. It's pretty easy to do, and it gives you some pretty darn useful information. So as we start, I think it's useful to just kind of think about the financial information we look at kind of on a regular basis. And one of the things we do, and we say, well, how'd the farm do? Well, probably the very first place you're going to go to is your income statement. And we've spent quite a bit of time on income statement types of issues in this webinar series. In fact, we had a Know Your Costs episode, which I think was number 26. Hard to believe we've done that many of them. And that was all the way back in July of 2021. We also looked at kind of accounting profits on a cash and accrual basis and economic profits. Bottom line, the income statement is a really super valuable tool and can really be helpful in thinking about your business. The other thing I think most of us think to look at is our balance sheet. And the balance sheet, as we all learned, a long time ago, is kind of a what you own versus what you owe kind of analysis. And we can do all kinds of interesting stuff with it. We can kind of look at the structure of the balance sheet, short-term and long-term assets and liabilities, and look at the match of that and all those kinds of things. And we also look at a cash flow statement, which will kind of convert all that into cash flows. But one of the useful things we can do, these statements make up what we call the coordinated financial statements, which means they all have to work together. So the income that you make has to kind of be reflected on the balance sheet somewhere. And the way we do that is with the statement of owner's equity, which is probably one of the least utilized statements that you see, but as I think you're going to see in a little bit, can be actually pretty darn useful. So let's take a look at looking at what earned equity is. And earned equity is just what we earn and what we hold on to. So net farm income, you take out kind of family withdrawals, things that you put money into in other places. And that's what you've retained in terms of earned equity. Now, there's, I think, about 4 reasons that this is really useful. First of all earnings aren't really equal. We have different sources of them. We have operating earnings. That's how much earnings our business is generating just by running it and operating it. We also have earnings that we get, and we call them earnings on a accrual adjusted framework, or if we mark our assets to market, well, those come from appreciation. And those are earnings that have occurred. I mean, for instance, we have farmland, its value goes up. That is an appreciation. It's a good thing. There's nothing wrong with that. But we haven't captured any of that until we actually sell those assets. So we have 2 types, and you kind of can get mixed messages sometimes by focusing on, say, just the income statement or just the balance sheet. That balance sheet can get really big when we have a lot of asset appreciations because we have lots and lots of assets, real estate assets in agriculture. The other thing I think it helps you do is it helps you understand how well your business, 1, generates earnings over time, and 2, how well you hold on to them. So sometimes we have business masterful at generating lots and lots of income, but we're just not very good about keeping those assets and those earnings in our business. It also can help us understand how fast and how well you can sustainably grow your business. So if we have a business with a really good earned equity generation machine or engine, we can grow our business pretty rapidly. Whereas if we're getting just a lot of our income or our growth through asset appreciation, sometimes that can be a little bit riskier to grow your business on. And it also helps us understand that kind of balance between, I think most farms, we have basically two businesses. We have an operating business that, we grow crops, we raise livestock. We try and do that at a cost where we can make money. That's kind of the operating side of your business. And then there's that investment side of the business.
So we're going to switch gears and we talk about earned equity, primarily an income statement activity that we're capturing. The other category of or source of equity change that we see comes from unearned equity. Now, I'll mention right off the bat, this is a really unfortunate name. Unearned equity has this connotation that doesn't mean, you can just envision all the ways that it unearned, you didn't earn something, how that can be conveyed. And that's, we want to sort of put up front, let's not get too attached to that being a negative connotation. This is a good thing for your business. This is a positive thing for your business. It's one of the big values or one of the biggest benefits of being in farming. You get to own these assets, they get to appreciate over time, and you get the earnings from managing those assets. And so don't get too caught up in that nomenclature. But we just want to mention up front that this unearned equity typically takes place on the balance sheet. It takes place through these balance sheets adjustments, not all the time, but if it's primarily from the balance sheet that we see these adjustments. And there's a couple ways that this happens. One of them is through irregular events, maybe such as a gift or inheritance. Maybe you inherited a couple hundred acres of farmland. You put that on your balance sheet. That increases your equity. Your balance sheet looks a whole lot better, but it didn't tell us anything about the operations side of your business, right? We didn't generate profit from raising corn and soybeans or livestock to get that farmland asset that also is an equity on our balance sheet. The second way we see big sources of changes in our unearned equity comes from the changes in capital assets. So think about farmland values increasing over time, thinking about our machinery and equipment being more valuable in the marketplace over time, or maybe breeding livestock. We might be buying cow-calf pairs. We value those cows at $1,000 a head, and over the next few years, the market changes, and maybe they're worth $1,500 or $1,800 a head. So these are ways that balance sheet can play out. Now, I want to mention earlier that these can be very consequential impacts for your business, but oftentimes as managers, we can't control this a whole lot. This is sometimes outside of our sphere of influence. If earned equity is kind of those operational decisions, our operational success, this unearned equity is sometimes, again, very consequential, but not necessarily part of what we're focusing on day-to-day activities. I kind of was thinking about this earlier, kind of a football analogy, if we can borrow something from sports. Earned equity is kind of putting together an offense that runs plays, passes the ball, gets first downs, accumulates yards, and tries to get a touchdown. This is sort of the blocking and tackling, the earned equity. The unearned equity would kind of be like the defense scoring a few points because they captured a fumble, or there was a interception they caught in return for a touchdown. Those defensive points can be really consequential to the game, but it's not something that we can plan on from play to play or from game to game. One of the reasons why unearned equity is really important, especially where we are today, is that their unearned equity can create some decision traps. Richard Feynman, and we've had a podcast or a webinar about this topic, about decision traps, and Richard Feynman's got a great quote that we've mentioned a few times in different episodes. And it's, the first principle is to not fool yourself, and you're the easiest person to fool. And I think that this unearned equity creates this management opportunity to maybe fall into these decision traps. And there's a couple ways that this plays out. The first one is what we call the wealth effect. Now, if you're not familiar with the wealth effect is this idea that when people have more money in their bank accounts or they feel wealthier, they tend to spend more money. And then on the other side of the coin, when people have less money in their bank account or they feel less wealthy, they spend less money. It's this disconnect between earnings and wealth. And we have to untangle this, because if we feel wealthy because of something that happened in our unearned equity, if we feel like our operation did really well, but a majority of that increase in equity came from farmland value adjustments, it isn't necessarily a reflection of the earning capacity of our business. So we might go out and make decisions like buying a new farm ground or expanding our operation or going on a big family vacation based on that wealth component, not based on how much we had generated in profitability. So that's the first piece of that wealth effect. The second one is we want to avoid something that we call the valuation yo-yo effect. It's kind of this emotional roller coaster that goes through that when farmland markets are going up, if we keep marking our farmland values up to the market, we get that positive wealth effect feeling going on. And then all of a sudden, if the market turns down, we got to reevaluate that land. We got to bring it down. That can kind of play to the other side of the pendulum swing. So we want to sort of manage this balance sheet in a way that we're not getting caught up in this wealth effect of feeling really wealthy one year because the farmland values went up and feeling really bad about our operations success because the valuations adjusted. So this is why we want to untangle these, and we want to think about these. We want to put two different lenses through our manager viewpoints, one on the earned and one on the unearned equity components. The second piece here is, if your estimates are wrong, which side of wrong do you want to be? So this idea of, okay, we're making these estimates. This is kind of an argument for being very prudent as to how we're putting together our balance sheet estimates and thinking about this over time, because in all reality, these estimates of our farmland values could be a little subject to error. We want to make sure there's some cushion in there, some financial cushion, that we're not pushing these estimates to the extremes. And then when there's a shock to the system, it doesn't create a bunch of challenges for our business. One of the points that's really relevant to mention here today in 2023, and we talked about this with Kirk Mankert in our earlier farmland episode back in January, is farmland values have changed a lot. And this chart shows the annual change in top quality farmland values in Indiana going all the way back to the early 1980s. And this is the dollar value that those annual changes make. So in Indiana this last year, farmland values were up 30%, and it was about $10,000 valuation. So that's a $3,000 per acre increase. So you can think about how much equity change that reflected in the balance sheet for these for operations. If they were marking that to market, it has huge impacts for that wealth effect or for that balance sheet. Well, we got to put some caution to that, right? Balance sheet should reflect those values that we could liquidate the asset for. So if we have to sell this farmland, we're going to have to accrue some sort of capital gains tax. And we're probably going to have to accrue some sort of transaction fees for listing or putting this piece of farmland up for auction. So this is another kind of 2 points here. One, this quantifies how big of an impact this recent farmland market could have on this unearned equity thing. You can think about how many years would you have to farm this acre of ground to raise corn and soybean profits to get something like $3,000 an acre in earnings. This could really distort your perception of how well your operation did if you're looking at this equity change without untangling unearned and earned equity. Second component here is not all of that $3,000 is going to be, available to you if you liquidated that asset. This is sort of a gross number. There's going to be a lot of other elements that we got to keep in mind. So this is one of the caveats for this, and we got to keep in the back of our mind to help you make better decisions as a manager.
David, I think I apologize to everybody. I was just talking away, and all of a sudden realized I was looking at a screen that said your Zoom session is over, and so I have no idea where it cut out. I was just yakking away. So the good thing is I'm sure David told you better things than I would have said anyway. So I think that the point you were just making, though, is a really important one. And that idea of that deferred tax liability that's on the balance sheet can be it can be really large. And so if any of you have thought about even retiring and selling that equipment that's been depreciated to zero and it still has significant value, you realize pretty quickly that the tax implications of getting rid of that can be substantial. And so, it's really useful to think about kind of what that deferred tax liability on the balance sheet really is, because in many cases it is really, really large. The other thing is that, we have these assets like farmland, and, there's kind of two approaches. Maybe you talked about this, David. I don't know. You can kind of value them at cost, as if they've never gone up, or you can value them at market. They went up a lot. It makes a big difference in how you look at your financial situation. And probably the best way to do is some combination of both. And we talked about that even in the budgeting scenario. Do you put in a really, really conservative budget, or one that I think reflects more reality, but maybe is a touch optimistic? And so I think those are all useful things, and the same issues apply here. So let's just take a little bit of a step at looking at that statement of owner's equity. And what we see here is the top portion of that statement. This individual started with a net worth of just short of right around $850,000. And in that year, they made $100,000. They used 80,000 of that on family living, and they had a total earned equity of $20,000. Now, that's kind of the earnings engine of that business. So generated pretty good income on that size of assets, but that family living consumed a whole bunch of it. So they kept about $20,000 in that business. Then on the unearned side, the portion of, they had some land that appreciated, some land appreciation. They actually inherited a little bit, and they had some appreciation in their livestock and machinery values. So they had $80,000 of unearned equity changes to get that total net worth up 100. Now, we're not here to say that's good, bad, whatever. That's reality, but it's important, I think, to think about, okay, if we want to grow that business, continue to grow that business, what can we do to boost that earned equity side of the ledger a little bit? Is there an off-farm job or something that can help keep some of those earnings that business generating keep it in the business?
And Brent, one of the things we've also talked about in earlier episodes, one about family living expenses, one huge differential that you could think about for your operation is, what is that family living component? If you could take it and you could work an off-farm job early in your career, you can work that lower. Maybe you're actually making a negative contribution. You're making some investments into your business. That could be a huge source of this earned equity component. And so we talked about both earnings that the farm generates, but also the ones that we retain. And that net difference is oftentimes that family living component. So there's a lot of ways that can play out. And this is a good way to look about how these two balance sheets from a year apart, $100,000 in equity changes. All right, what were the sources of that? And we might come to some different conclusions if it's 20,000 earned and 80,000 unearned versus the other way around, 80,000 earned and maybe 20,000 unearned. So this is a way for you to help think about that. So as a bit of a wrap up here, before we get to our lender expert, Chad, this month, we're going to talk about, we're going to wrap this up with a few ideas. So first off, really important to keep the two sources of equity changes in mind, earned versus unearned. On earned equity, it's really important that we measure and track it over time. We want to get a good feel for how that is trending in our operations. It gives us some idea about future opportunities and future growth. On the unearned equity, it's important to observe it and remain cautious, maybe even dubious of it. We want to make sure that we observe it, and it's, again, a good thing. We want to see unearned equity changes, but we just don't want to necessarily build a business model around counting on those or anticipating those, especially for several years in a row. Second piece here is to make sure we consider those deferred tax liabilities. Those can be quite substantial, especially when we see farmland values change a lot. And the third piece here, we're talking to Chad a little bit about, is establishing a consistent process for monitoring that and measuring that and making some plans and procedures in place. And finally, I want to encourage you all to think about this statement of owner's equity. Maybe you can create one of these for your own operation. Maybe you already have one of these created, and you can start to use that a little bit more in your decision-making process. But the main goal for that statement of owner's equity is just to think about, how did the equity change over year in total, and then what were the big sources of that change: income, family living, and then all these valuation changes. So it's a great tool to have and to use in your decision-making process. So at this point, we're going to invite Chad to join us. Chad's going to talk with Brent and I for a little bit here. And of course, we'll stick around for the overtime. He's going to join us in answering all your questions. So make sure you submit your questions through the Q&A portal for the overtime section. But Chad, thanks so much for joining us this month. I want to kick it off by having you tell us a little about yourself.
Yeah, thanks, David. Thanks. Appreciate the opportunity to be here this afternoon and Yeah, my name is Chad Jacobs. I'm a financial services officer here in the Red Oak, Iowa office. I've been with Farm Credit a little over 17 years. Grew up here in Southwest Iowa on a family farm. My brother and my dad they farm together, and I help them from time to time when they need a little extra help on the farm in the spring and the fall, and with cows. My wife and I have twin daughters. They're juniors in college, and we've got one at Iowa State and one at Northwest Missouri State in Maryville. So, just excited to be here this afternoon and visit a little bit about this topic.
Well, great. The first question I have for you, and I kind of split these questions, and let's talk a little about earned equity, a little bit about unearned equity, and we'll try to pull this back together. But for the earned piece, can you share an example or maybe some thoughts around how producers have used this earned equity component of their operation to help grow their business, or how they use this in the decision-making process?
Yeah. An earned equity trend can be a useful tool, especially say a younger producer or somebody they're growing their operation. You look at the income statement. If you're adding acres, you're adding animals, cattle or hogs or whatever it may be. The expenses are a lot of times get out ahead of the income or those new assets or acres that you're adding. So when it comes to making a lending decision, if you're looking at the income side of things, those extra expenses, the income side may not look quite not give you the true picture. But if you have a consistent earned equity trend, that's a tool you can use to kind of look at the repayment capacity on a new loan request. So it's just one tool that you can use that to kind of help make that decision. The one thing I'll preface with that is the environment we've been in the last few years here, where we've gone through a pretty nice cycle here in agriculture. That's the earned equity trend wouldn't be something you may want to totally rely on, because things have been pretty profitable lately. So you want to be also realistic of what things will look like in the future. But it's a good tool to use to kind of put all the pieces together when making a decision especially on an operation that's been changing, increasing in size over the years.
Yeah, it's a really great point that you mentioned. There's sort of the unearned equity, the farmland value changes that we talked about, but also the earned equity trend has been really strong the last few years. And so untangling those a little bit allows producers to really put some thought around that, to do a little bit of math and say, hey, this is maybe what I can plan and project for 2 or 3 years down the road, or this is a range of reasonable estimates.
Yep.
When it comes to the unearned equity, we spoke a little bit about marking to market, bringing our farmland values up to market, and then the purchase price. So it's kind of this extremes. You can mark them to market. When you do that, you got to be careful to defer taxes. But on the other hand, you can sort of leave them at the book value or the purchase price. Can you explain some of the downsides, if there are any downsides, of just leaving the farm valued at what we purchased at when it comes to the balance sheet?
Well, especially if you get into a situation where the producer is going to be adding a significant amount of acres or debt, and relying on some of that, existing equity they have in the land they already own. It can distort their true owner equity position. So that at that point you may want to, if they're significantly undervalued, you may want to address that, just so you get a truer picture of where they are on an after close, after the transaction is finished basis. If they've got ground on there at 25% of what it's worth, just because that's the way it's always been, and they're adding acres at current market value, you probably want to move those existing ones up just a little bit to get a truer picture of where they're at. So when we review your ratios of where you're at. We don't want to project you at a lower owner equity just because things are way undervalued. So
one of the positives might be it forces the managers to think about the cash flow implications of buying that next farm, right?
Right. Yep.
We talked a little bit about unearned equity creating challenges for management, and from your perspective, what are some of those challenges? We've shared a little bit, but what are some of the challenges that you've seen as you work with a lot of producers?
The unearned equity, like you talked about, the wealth effect. it can kind of fool you into a sense of, getting away from, okay, looking at the repayment capacity from an income side versus the wealth effect. The other perspective, the other problem that can with those higher asset values, if a lender only focuses on the collateral and that current value, lending into that, and Brent touched on the deferred tax liabilities. Getting out of one of those situations can be difficult because the sale to reduce debt can trigger significant taxes, which then decreases the cash available after a sale, and it can kind of get into an ugly spiral if you only focus on the current value of something versus all the other aspects of it.
Those situations where we get ourselves in a little bit of a tight spot, and unwinding that can be very,
Yes.
very challenging, especially
Yep.
if we have to unwind a significant portion of that.
Yep.
So if a producer is wanting, we mentioned earlier, a good strategy here is to be consistent in how we're updating our balance sheet, maybe take some of the emotions out of it, put in some processes to maybe make this a little more automatic or a little less subjective from year to year. What are some specific tips and strategies that you have in this space?
Yeah, exactly. The word you touched on there is consistent. Consistent in how we value things year to year, and also consistency on timing. And being consistent on time of when you do that balance sheet every year. It doesn't necessarily have to be done at the end of the year. Maybe it's that's always probably a good time to do it, but if it's a February 1st or it's a November 30th or whatever the date may be, being consistent on that time year to year allows that trend to be more accurate. So you're not going 9 months between balance sheets to 15 months the next time. I went back and looked, and I have one customer. We've done a balance sheet the week of Thanksgiving every year since 2008. So very consistent on timing, and it makes the process, I think, easier because they know that's when we're going to do it. They're ready, and try to get a lot of my customers do them at the same time every year, and it just makes the process easier. I think it's more accurate that way. And then also on the valuing of the assets, on how we depreciate machinery and equipment, and improvements, and being consistent on that year after year, that just makes everything a lot more accurate.
I have a couple more questions for you. One of them is, we talked a little bit about the impact that farmland values have had in this distortion. So big changes in farmland values can make this equity change more important to keep a really close eye on. Are there other points in our careers? Maybe it's where we are personally at the beginning, towards the end of our career, or maybe it's the types of livestock, or maybe crops versus livestock, or any other demographic factors that we need to keep in the back of our mind. So when we need to be very cautious about this earned versus unearned equity component.
Yeah, I would just say, just being back again to the wealth effect, and just being conservative on, it never hurts to be a little conservative on those values, just because the deferred tax liability and those issues when it does have to be unwound at some point. I guess, yeah, those would be the main things.
Okay, one last question for you before we kick it back to Carly from our side today, and we're going to get to everybody's questions in the Q&A here in just a few minutes. What's a piece of advice that you'd put on a billboard here in March 2023 for producers to see and to think about?
Yeah, I'm sitting here in my office. There's a quote that I've got pinned up here on the wall in front of me, and it's kind of where we are at today with a lot of uncertainties in the financial markets, and Russia and Ukraine, and high input costs for producers, and there's just a lot of uncertainties. And this was a quote that I heard years ago, and I wrote down, and I think it's a good one to kind of keep in mind. It just says, problems are opportunities that are wrapped in uncomfortable situations. So, I hate to be negative, but it's kind of a positive spin on uncertainty, and maybe when things aren't always as rosy as you'd like. So that's kind of my one that I have up here and I try to look at from time to time. So.
Well, Chad, that's a great note to end, wrap up here with today. Thank you so much for your contributions and for sticking around for the overtime.
So we have a few questions. Start with one, which I think is a really good question, and not necessarily the easiest one to answer. So what's the best way to treat lease to own items on the balance sheet? No value shows up until I pay the residual, and then it drops a substantial amount of asset on the asset side. So that's a good question. That's one people have struggled with for a long time. And I think if you go back to, there was a group called the Farm Financial Standards Council that came out of the 1980s as a way to try and improve farm record keeping, with the idea of, giving people a better assessment of where they're at. And one of their recommendations is that, leases should be on the balance sheet, and how you should handle them is put the value of the asset on the asset side and the liabilities on the liability side. And so they kind of net out. But the reason to do that is because those lease liabilities are actual liabilities and you have to pay them. It's important to reflect that on the balance sheet because it's something you own. Now, you want to have to kind of offset just, oh, well, I just leased something that's only a liability. Well, no, you get the use of that asset. And so they kind of came up with a compromise way of doing that. So show it on the asset side, but as well on the liability side, so we don't understate our liabilities. And then that will help, I think, with the how your situation is handled there. And of course, when you pay that residual, that's going to take cash out of your cash to pay for that piece of equipment. So you're kind of converting cash to a piece of equipment. Maybe, hopefully, if you're doing that, you're getting equipment's worth more than the residual value. So that's how I think we should handle is it needs to be on the liability side for sure. I think everybody agreed with that, and the best way to handle it is to put something on the asset side as well to offset it. David, and then Chad, I don't know. I probably should. I don't know how Farm Credit actually handles those. So that was the professor response.
Yeah, that's the way we handle it. We show it on both sides on the balance sheet.
Well, good.
The challenge a little bit sometimes is getting the payment with a lease where you got the residual at the end of getting the payments to show up, to match on the liability side. But we show both. But.
Right. It's tricky, and that's why it's a good question. What about basing unearned equity over an average, say a 10-year average versus year over year? Again, I think when we look at those assets, particularly farmland being the biggest one, because those are the assets that tend to appreciate the most. There's a lot of different ways one can do it. And like I said earlier, some people would say, well, if you talk, my dad, he'll say, well, this is what I paid for, that's what I valued at. Well, yeah, that's one way to do it, but it's probably not a full reflection of reality, and we want to try and get it somewhere close to reality. And so, if you feel like that 10-year average gives you a better perception of what is real, then I think that's fine. As I think Chad said in his comments, do it consistently, so they're not bouncing stuff around up and down all the time, and because some of that starts to look a little bit like financial engineering, and we don't want to do that. We're trying to get information to help us run our businesses better, and so I think the best depiction of reality is what you should do, but it doesn't mean just writing in what the highest auction price in the county was today, because that's not real either, because you wouldn't capture all of that if you sold it, and most of people don't really want to sell it anyway. I don't know, Dave, if you have anything to add to that.
I think the key part there is to create a consistent process, talk with it talk about that with your teammates, your family members, explain what the rationale was, what are some of the benefits of that method, what are some of the blind spots of that method, and then recognize that when you work with your lender partner, they might have a different process for their underwriting. And so each decision that we make might require a different lens to view that data. But I think, the fact that this question is out there is a great first step. Just make sure we know what questions we're trying to answer with that, and does that line up with the goals of the business in the long run. So it's really a great perspective.
Yeah, I think the biggest thing we're trying to do is not confuse, a business that's generated most, where to help people understand, just understand where the sources are coming from. Because if you confuse, a lot of appreciation, equity growth with operating earnings equity growth, you can get yourself into trouble. And so we want to just make sure we really understand what that operating engine is doing, because those valuation changes can change dramatically. Recently, they've been upward, but it's possible they go the other way too. And that leads into another question about a couple of questions about farmland. One being, with these higher interest rates, what is going on? What is likely to go on with the capitalization rate of farmland? I don't understand purchases for 2% or lower cap rates, and I think that's a good observation, a good question. Interest rates are really important in asset values like farmland, but their impacts are not felt immediately. And so sometimes we can see things happen like this when rates are rising really rapidly. You can look out and the farmland market doesn't appear to be adjusting as much. And part of that is because only a limited amount of it sells. It's not like the stock exchange where we have really liquid markets for all these assets that are trading every day, every second. Bond markets the same way, with lots and lots of people buying and selling. It doesn't happen in farmland. So sometimes it takes a while for the reality of those changes to set in. But my view is that with higher interest rates, if they persist, it will eventually work its way into farmland capitalization rates. And that means that a couple of different things have to happen. Either the income has to go up to make the capitalization rate higher, or the asset value has to adjust to increase that. And how that plays out is going to be interesting over the next few months and years, because I think that is a really important question right now. In the farmland market, we have strong earnings, and that's a good thing. But we also have that big headwind of higher interest rates, and it hasn't necessarily, I don't think, been felt yet, but eventually I think it will. And that leads into the next question of, what is the trend on farmland prices going forward? And I think, again, the trend so far has been higher. I mean, the chart David showed, it's pretty dramatic how much farmland has increased over the recent years. Two things fueled that. One, when we did have lower farm incomes, or a few years in there where we didn't have such great farm incomes, remember the trade war and all this time. But what we had was really, really low interest rates, like, farmland mortgages at 3% or something. That really helped. Okay. Then we got in a situation where we had high incomes and low interest rates. That's really good for farmland. And now we're kind of in this situation where we have pretty strong income, but much higher interest rates. And that's, I think, going to be a factor that I think is going to put at least a little bit of pressure on that farmland market. But it's going to depend where that income situation, I think that is the immediate one that really impacts it in my mind. But those interest rates do play an important role in the long run. So a long answer to a short question.
And Brent, I'll just add, the farmland market has been red hot. And so I've been seeing some headlines saying, oh, the farmland values are cooling or they're soft. And if you look at some of the data, it's increases that are smaller, but it's not, I haven't seen data showing a decline in farmland values. It's just increasing at a slower rate. And that slow rate relative to last year is actually a really strong rate relative to over our career. So this, we call this the base effect, right? What is the base? We're changing from phenomenally high valuation change to something less phenomenal. And it's hard for us to wrap our mind around that.
Yeah. Yeah. Oh, I see. And we had another one come in here just the last minute as Carly was getting ready to take over. Okay, so basically it's asking, if we have farmland that has, I believe it's how it's, if we have farmland that has other things on it like hardwoods, impact the appraisal of a farm. And I'd say yes. How much, I guess, depends on the type of hardwood and the type of value and all that. And it can be a pretty volatile component of it as well. So I would say that, valuing those woods can be, you have to have an expert do it to really get a good handle on it and realistic value of it. So, but yes, it would impact the value of farm, I think. And I think that's it, Carly.
Okay.
Chad,
I think that's it too.
Chad, do you want to say something?
No,
Okay.
That's a question I don't have a whole lot of experience with down here in our area. So
well, we have no hardwoods, and well, we have a few, but not.
Do you have trees out there, Brent?
We not very many. We can't. We don't want to cut them down because you have to have a little shade every now and then.
It's a good question too for a local appraiser. So if you've got a specific scenario, I think it's always good to reach out to your local team, and they can always kind of like throw that question around a little bit more where it's applicable. So good question, appreciate it. And that'll do it today for another episode of Two Economists and a Lender. And thank you to Brent, David, and Chad for leading today's conversation. And for you in the audience, thank you for joining us. We look forward to seeing you online again next month.